Hello, everyone, and welcome back to The Deep Dive, the show where we put the world's most powerful, least understood corporations under the investment microscope. I hope you are ready for a thorough analysis.
Today, we are dissecting a company that many people might find complex or even a bit boring on the surface, but which is, in reality, a global financial titan. This company doesn't sell physical goods. It sells the most essential, non-material commodity in existence: predictive data and critically trust.
That's right. Today, we are performing an exhaustive analysis of Marsh McLennan Companies, or MMC. This is a massive professional services firm that dictates how the world's largest corporations manage risk, talent, and strategic change. It is, I think, a genuine Tollbooth business.
And our mission today is laser-focused. On the surface, MMC is a premium-priced blue-chip stock. But the real question for us, as long-term investors, is this: is that premium valuation actually justified by the durability of its economic moat and the quality of its financial profile?
Exactly. We want to know, is this 150-year-old fortress truly impenetrable, or are there vulnerabilities hiding just beneath the surface of all that global sophistication?
That's a massive question. And before we get into the details, just a quick note for everyone listening.
For those who want to act on these investing ideas, having a professional-grade platform is, well, it's key. We use interactive brokers, and we've partnered with them to get our listeners a stock bonus when they sign up.
So you get a bonus and support the deep analysis we do for the show at the same time. That link is right there in the description, right?
That's right, or on our website. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and hit that like button. It truly helps us bring these detailed analyses to you.
Absolutely. And if you have any questions regarding MMC, please manifest yourself in the comments section. Now let's get into it. Pillar number 1, the business model and why this structure creates such a compounding advantage.
Okay, let's unpack this structure, because understanding MMC is really about understanding how 4 unique, powerful engines work together. We often talk about 2 pillars, but it's really 4 heavy-hitting businesses all reinforcing each other.
That's the key, the structural diversification. The first pillar is risk and insurance services. This is the core, the high-volume global risk transfer engine.
Okay.
Within this, you have Marsh, the global insurance broker. They act as the intermediary between the big corporations and the insurance market. They're the ones who place the risks.
And then, uniquely positioned right alongside Marsh, you have Guy Carpenter. Now, this is the global reinsurance specialist. They don't broker risk for the company itself.
No, they broker risk for the insurance companies. They help the actual carriers manage their own massive, massive risk portfolios.
So they're a broker to the brokers, in a way.
A consultant and broker to the insurers, exactly.
Yeah.
Now, the second pillar is consulting. This is equally vast, and it's focused on the intangible assets, human capital, and strategy. This houses Mercer, which is an absolute powerhouse. They focus on health, wealth, and career consulting. So, the massive human capital and benefits side of the corporate ledger.
And finally, rounding out this quartet, you have Oliver Wyman. This is the high-end, the elite strategy and management consulting arm. They're the ones tackling the C-suite's toughest questions on, operational effectiveness, M&A, that sort of thing.
The beauty of this revenue model is its purity. It's all commissions and fees. There is no major capital required for inventory, for production, for anything physical.
They sell ideas.
They sell intellectual property, tailored advice, and access to proprietary market knowledge. This makes the revenue generation inherently scalable and, maybe most importantly, incredibly capital light.
What's fascinating to me is the endurance of this model. When we look 10 or 20 years down the road, we have to ask, what corporate expenses are truly non-discretionary? And, risk management and high-end expert advice have to be at the absolute top of that list. A CEO might delay an IT upgrade, sure, but they cannot delay addressing a critical existential risk to their business.
No way. And this feeds directly into the structural tailwinds we see globally. It's not just about managing the risks we already know about. It's about navigating a world of accelerating complexity.
So things like climate change.
Absolutely. Think about the demand for their services related to the energy transition and green risk. Think about the exponentially increasing complexity of cyber risk, which is now treated like a physical catastrophe risk.
Like a hurricane or an earthquake.
Precisely. And then you layer on geopolitical instability and the massive permanent evolution of the global workforce requiring totally new benefits and talent strategies. all of it.
And every single one of those factors increases complexity. Critically, that complexity increases faster than global GDP. So if complexity is your product, then increasing complexity means accelerating demand. It's a fantastic place to be positioned.
It creates a self-reinforcing loop, and it's driven by a very basic human psychology. When a massive global organization faces extreme uncertainty, say, integrating regulatory changes across 30 different jurisdictions after an M&A deal.
Or a multi-billion-dollar environmental liability.
Right. They're not going to turn to some unproven new vendor. They default immediately to the largest, the most reputable, and most importantly, the most data-rich experts in the world. And that position is fundamentally owned by MMC.
So let's move from the model to the moat. Where is the competitive fortress actually built? Because this is what justifies that premium valuation we talked about.
Well, the moat is built on two primary factors, and they work in tandem. First, intangible assets, specifically branded reputation, and second, those extremely high switching costs.
You can't put a 150-year history of established client trust on a balance sheet.
But it is their most valuable asset, absolutely.
That tenure, it just establishes an unparalleled level of trust. I mean, if you are the risk manager placing tens of billions of dollars in specialized risks, say, captive insurance for a major tech company, you are betting your company's future on the fiduciary competence of Marsh. You're betting your career on it.
Exactly. Now let's break down how this moat is enforced by data, specifically within the risk and insurance segment. Marsh, by its very nature, attracts the clients who face the most complex risks. Think massive petrochemical companies, global airlines, or major pharmaceutical manufacturers.
And those complex risks, what do they translate into for the rest of the MMC ecosystem?
They translate into superior proprietary risk data. This is the intellectual property. Guy Carpenter, the reinsurance arm, benefits directly from every single transaction Marsh facilitates.
How so?
They are gathering vast amounts of granular, real-time global loss data, scenario modeling data, predictive analytics that their rivals simply do not possess at the same scale or the same level of complexity.
So they aren't just selling a transaction, they're selling a deeper, almost fundamental understanding of risk itself.
Precisely. This vast data set allows Guy Carpenter to become an invaluable consultant to insurance carriers all over the world. They can better structure and price the risks that the insurers themselves take on.
Which means better outcomes for the carriers.
And better placement and pricing for Marsh's original corporate clients. It all connects.
And that efficiency, that better placement and pricing, it just reinforces Marsh's reputation, which in turn attracts even more clients with the most complicated risks. This is the virtuous data cycle in action.
That's it. It constantly widens the gap between MMC and everyone else. It's a classic network effect, but it's applied to knowledge and data. Every new complex client added to Marsh reinforces the data quality in Guy Carpenter, which in turn makes Marsh more attractive to the next complex client. It's self-sustaining and it's constantly getting better.
And the high switching costs you mentioned, let's try to quantify that difficulty. If I'm a global multinational, what am I actually risking by trying to switch from Marsh to a smaller competitor?
You're risking continuity, you're risking compliance, and you're risking custom integration. Switching brokers for a global company is not an isolated event. It involves integrating completely new risk models, transferring decades of proprietary loss history data,
Making sure you're compliant across dozens of countries at the same time.
and retraining all of your internal risk teams. The operational burden is just immense. The cost isn't just the fees you pay. It's the risk of errors or coverage gaps that could literally cost you billions of dollars.
So it's inertia fortified by fear.
And that fear constitutes an incredibly durable high switching cost.
This brings us to that nonlinear element that Charlie Munger highlighted, the Lollapalooza effect. The combination of these four businesses creates value far, far exceeding the sum of the individual parts. How exactly does this integrated structure enhance that client stickiness we just talked about?
Okay, let's use a hypothetical client example. Let's take Global Dynamics Corp, a multinational firm. And let's say they're facing significant talent retention issues in Asia. And at the same time, they're preparing for a major acquisition in Europe.
Okay, so a classic complex situation. Global Dynamics Core is dealing with strategy, talent, and risk exposure all at once.
Exactly. First, they hire Oliver Wyman to conduct deep due diligence on the European acquisition target. The team focuses on strategic fit, future market growth, and so on.
Standard consulting work.
But that strategy team immediately flags that the new company's pension liabilities are massive and, frankly, they're poorly managed.
Ah, so the strategy consulting immediately feeds directly into the human capital pillar.
Right away, Mercer steps in. They leverage their proprietary global compensation and pension data to completely restructure the European firm's pension program. They redesign the benefits package to reduce the liability while simultaneously improving talent retention.
So they're addressing the balance sheet issue and the talent drain in Asia at the same time.
At the same time. Now that they have a clearer picture of their total enterprise value and their risk,
We turn to Marsh.
they turn to Marsh.
All right.
Marsh now places the risk for the newly acquired European entity, but they do so leveraging the refined data and the clear liability structure provided by Mercer and Oliver Wyman's strategic analysis.
And Guy Carpenter's role.
Furthermore, they use Guy Carpenter's sophisticated modeling to structure bespoke reinsurance coverage for the complex residual liabilities, ensuring the entire risk transfer is optimized and, as cheaply priced as possible.
So MMC is now completely embedded in the client's corporate DNA. Strategy, talent, finance, and risk all linked under one single provider. If Global Dynamics Corp tried to switch out Oliver Wyman for, say, McKinsey or Marsh for Aon,
They would risk shattering the coherence of their entire multifaceted solution. They would break the system.
the Lollapalooza is the ultimate barrier to replacement then.
It is. You are not just buying a broker anymore. You are buying a fully integrated risk and talent ecosystem. The client pays a high price, yes, but they get centralized accountability for systemic enterprise-wide risk. And that integrated solution is exponentially more valuable and difficult to replace.
So let's talk about the competitive landscape. We know they operate at the high end, but the scuttlebutt, what clients and competitors are actually saying, is crucial. Are clients genuinely happy, or are they just tolerating the high commissions because they have to?
Well, the perception varies, but the core feedback really revolves around competence and fiduciary performance. For complex, emerging risks, cyber, ESG-related risks, political volatility clients don't merely tolerate MMC, they rely on them critically.
So the value is there when it matters most.
Exactly. The commissions are high, and they're often a target of scrutiny, but the perceived value is judged primarily by the quality of the outcome when a catastrophe strikes. When things go catastrophically wrong, MMC's competence is suddenly seen as priceless.
And what about on the employee side? I mean, since human capital is their core asset, how are they attracting and retaining all this expensive talent?
This is a constant, ongoing battle for them. Within Oliver Wyman, they're competing directly with the MBB firms, McKinsey, Bain, BCG for the top graduates.
It's the best of the best.
Within Mercer, they compete with the human capital divisions of rivals like WTW. Management recognizes this. They're focused on the whole person health employee value proposition, or EVP. It's all about holistic well-being, flexible work, prestige projects that's absolutely critical to retain their knowledge-based assets. If that EVP fails, the consulting arms bleed talent and the whole engine slows down.
Let's analyze the three primary rivals then, and MMC's durable advantage against each. First up, Aon.
Aon is the most direct global rival, no question. They have been highly focused on technology enablement, building out platforms and using data very aggressively. Their whole aim is to be the most technologically advanced risk advisor.
So what's MMC's durable advantage here? Is it just legacy?
It's diversification and sheer consulting depth. While Aon is superb in the brokerage space, MMC's full integration of Oliver Wyman and Mercer provides a strategic and human capital offering that Aon, well, they just lack the scale in.
So MMC can solve the whole corporate problem.
Not just the risk transfer problem, that's the difference.
Okay, next, Willis Towers Watson, WTW.
WTW is very strong, especially following their own M&A history. They are particularly formidable in the human capital space, but MMC retains the advantage in sheer scale and brand dominance in the really strategic risk areas, global commercial property and casualty, and of course reinsurance, through Guy Carpenter. When you are looking at the largest, most strategic corporate accounts in the world, Marsh's brand carries the undeniable weight of history and scale.
And finally, Arthur J. Gallagher, or AJG, the acquisition machine.
Right. AJG's strategy is all about volume and growth through constant tuck-in acquisitions. They primarily target the mid-market and smaller regional accounts. Their focus is just different.
So how does MMC's advantage play out there?
MMC's advantage is prestige and dominance in the enterprise risk space, the Fortune 500 accounts. AJG aims for breadth. MMC aims for the highest complexity and strategic scale, where that Lollapalooza effect is most pronounced and, frankly, most highly valued.
Yeah.
MMC is selling bespoke integrated solutions. AJG is executing a high-volume consolidation strategy, Two different games.
Okay, so that's a perfect transition. Let's move into the second priority, translating this powerful business model into sustainable shareholder value. We need to confirm that the management stewardship and the financial profile are actually worthy of that premium price.
This is the acid test, isn't it? A great business can be absolutely ruined by poor capital allocation. Let's start with the leadership. John Q. Doyle, though he was only appointed CEO in 2022, has deep institutional knowledge. The real question is, what's the overarching mindset that guides their decisions?
Doyle's philosophy seems to center on leveraging the collective expertise of the four businesses. He calls it expanding what's possible for our clients. But fundamentally, his focus is on long-term value creation and operational efficiency, things like centralizing shared services to expand margins over time.
Well, the proof of an owner-oriented mindset is always in the incentives. Compensation is tied explicitly to metrics that prioritize profitable growth. They focus heavily on operating income growth, organic revenue growth, and critically adjusted return on invested capital, or ROIC.
And why is linking executive pay to ROIC so vital for us as investors?
Because it forces management to think like shareholders. It's that simple. If an executive proposes a big acquisition or a major new technology initiative, they have to ensure the return generated by that investment substantially exceeds the cost of financing it.
So it prevents empire building?
It prevents empire-building growth for growth's sake, and it forces rational, profitable capital deployment. It's the numerical signal of capital allocation discipline.
Let's detail that capital allocation discipline then. They seem to deploy cash consistently across three highly rational pillars. What's pillar one, the necessary upkeep for a knowledge business like this?
Pillar one is sustained reinvestment. They absolutely have to continually invest in their technology infrastructure, data analytics, AI modeling for risk prediction, and internal talent development platforms. They have to maintain their data superiority and keep the consulting talent ahead of the curve. This is not CapEx on machinery. It's investment in intellectual capital.
Pillar two is the direct return to shareholders.
Right. Shareholder returns. This manifests in a consistent growing dividend, which is a sign of confidence in the resiliency of their future cash flows. And, importantly, opportunistic share buybacks. The recent multi-billion-dollar buyback authorization is a massive signal to the market.
So when a company authorizes, say, a $6 billion buyback, how should we interpret that beyond just the headline number?
It signals a conviction that the stock is intrinsically undervalued at certain prices, or that they simply have high levels of excess cash that cannot be deployed efficiently into high ROIC M&A or internal projects at that particular moment.
It's discipline.
It demonstrates a highly disciplined approach, prioritizing returning capital to investors over hoarding it, or worse, engaging in low-return ventures just to look busy.
And the third pillar is strategic M&A.
And they focus exclusively on what they call strategic synergistic acquisitions, the tuck-ins. These are smaller specialty acquisitions designed to fill specific geographic gaps or niche product expertise.
Like buying a boutique firm that's highly specialized in Latin American cyber risk or something like that.
Exactly. They're culturally easy to integrate, and they immediately contribute to the margins. They're actively avoiding the massive speculative M&A that characterized earlier decades in the industry, which so often risks cultural evil and balance sheet impairment.
This disciplined management philosophy should translate directly into exceptional financial ratios. So let's start with the gold standard for durable businesses. Return on invested capital, ROIC.
This is where the moat really shines through numerically. While MMC has some variability year to year, reported figures consistently land in the mid to high teens. Let's look at a recent period where their trailing 12-month ROIC was around 13% to 15%.
An ROIC in the teens for a service business is very impressive. But what does that 13–15% ROIC actually tell us about their competitive standing?
It tells us they possess a value-creating competitive advantage. I mean, if we estimate their cost of capital, the blended cost of their debt and equity, say 7% to 8%, then every dollar they invest generates a return that is nearly double that cost.
And that gap is the moat.
That significant gap between ROIC and the cost of capital is numerical, irrefutable proof that the company is a wealth creator and that the economic moat built on data and trust is financially viable and sustainable. It's what separates a truly wonderful compounder from just an average business.
That makes perfect sense. Now, let's move to the cash flow, which, as we know, can often be superior to reported earnings. We look at free cash flow or FCF conversion.
And FCF conversion is a massive strength for them, and it's due entirely to their business model. Recently, operating cash flow exceeded $5 billion, which converted net income of roughly $4.13 billion into significantly higher free cash flow.
So why is that conversion rate so high? Why is the FCF so much stronger than the net income number?
The capital light structure is the simple answer,
Yep.
but let's explore the mechanics a bit. For a manufacturing company or a utility, capital expenditure CapEx to maintain machinery, property, plants, it's immense. It's potentially hundreds of millions, if not billions, every single year. For MMC, maintenance CapEx is minuscule. Their primary assets, their people, walk out the door every evening. Therefore, the vast majority of their operating cash flow is immediately available as discretionary free cash flow.
So their reinvestment, that pillar one we talked about, it's mostly intangible spending. It's talent and tech development, which often falls into R&D or operational expenses rather than massive depreciating physical assets on the balance sheet.
Exactly. And that structural advantage allows them to fund the massive dividend and the multi-billion-dollar buyback program with incredible efficiency. This efficiency is a massive and I think often underappreciated competitive advantage for long-term shareholder returns.
And finally, let's touch on balance sheet strength. How much leverage do they actually take on given these predictable cash flows?
They are very prudent. The stability of their fee-based recurring revenue means they can safely carry a moderate amount of debt. Their net debt to EBITDA ratio historically runs below 2.0x, recently reported around 1.8x.
Which is very manageable.
Highly manageable and optimized. Because their cash flows don't suffer the massive cyclical collapses that a capital-heavy business would endure, they're able to service this debt easily. And that's why they command strong investment-grade credit ratings from the agencies.
So we have established MMC as a high-quality, wonderful business. Now we confront the reality that always dictates investor success: valuation.
And this is the hard part. MMC notoriously trades at a premium multiple relative to the broader market and even to some of its competitors. So why does the market allow this premium? Why do they pay up for it?
Well, the market views MMC as a classic Tollbooth stock, and you always pay a premium for predictability and quality. This premium is really just payment for the combination of high revenue recurrence, the capital light structure, the durable moat, and that excellent cash flow generation we just covered.
So the premium you see in the trading multiple is simply the price the market assigns to lower volatility and higher long-term compounding certainty.
Exactly. But for the shrewd investor, quality rarely comes cheap. This immediately raises the question of a margin of safety. If we are paying full price, or even a premium price, where is our buffer against being wrong?
You have to redefine the concept of margin of safety for a business like MMC. You are highly unlikely to ever find it trading at a massive absolute discount to its intrinsic value. I mean, unless the entire market has fundamentally misjudged the business.
So you have to look for something else.
Instead, the margin of safety resides in identifying specific, non-permanent entry windows, opportunities.
What are those specific windows that we should be looking for?
First, an indiscriminate market-wide panic, something like a systemic financial crisis or a major geopolitical shock that causes a temporary irrational sell-off across all high-quality names. The baby gets thrown out with the bathwater.
And the second window.
Second, and more specifically, look for a company-specific temporary setback that does not impair the long-term fundamentals. This is key.
Can you give us an example of a temporary setback that doesn't actually damage the moat?
Sure. A one-off regulatory fine in a minor jurisdiction. A large one-time charge related to centralizing their operations. Or, and this is a common one, a sudden temporary softening of commercial property and casualty insurance pricing that causes a short-term EPS miss.
But the underlying business is fine.
If the long-term compounding ability, the data cycle, the Lollapalooza effect, if all that remains intact, those moments of anxiety offer the true margin of safety for the high-quality investor.
This brings us back to Buffett's famous maxim. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
And MMC is undoubtedly a wonderful company, but the investor must internalize that the entry multiple remains the final hurdle. If you pay an excessively high multiple, say 25 times forward earnings when its historical average is 20, you are pretty much guaranteeing yourself mediocre returns, regardless of the underlying business quality.
Quality is not a license to overpay recklessly. The entry multiple dictates your compound annual growth rate, your CAGR.
Let's pivot to growth. If complexity is their engine, how does that translate into sustainable growth numbers year after year?
The primary, single most important identifiable growth driver is the global increase in risk complexity and volume. This is a secular structural tailwind that really transcends the short-term economic cycle.
We're talking about permanent global shifts here.
Yeah.
Digitization, creating novel cyber threats we haven't even thought of yet. Geopolitical fragmentation forcing corporations to manage incredibly complex sanctions and supply chain risks.
And the big one, the massive capital requirements and insurance needs surrounding the transition to clean energy.
Don't forget the evolving demands of corporate governance, ESG, all of it. These transformations are not temporary economic cycles. They are permanent, accelerating changes.
And because these issues are highly complex and often require integrated solutions, risk, talent, and strategy, the demand for MMC's sophisticated integrated services will naturally grow significantly faster than general global GDP growth.
They're surfing a permanent wave of corporate anxiety. That's a good way to put it. Now, for the catalysts, the factors that could accelerate growth beyond that baseline. You mentioned two key factors.
The first is the sustained hardening of the insurance market. This is absolutely critical to the brokerage segment's revenue growth.
Can you explain what a hard market means and why it's such a boon for Marsh and Guy Carpenter?
A hard market occurs when insurance premiums are rising significantly and capacity, that's the willingness of carriers to take on risk, is tightening across P&C and reinsurance lines. This usually happens after large catastrophe losses, or during prolonged low interest rates, or after regulatory changes.
And the brokerage business model.
The brokerage business primarily operates on a percentage commission basis.
So if a corporation's premium for insuring its property portfolio goes up 20%, Marsh's commission revenue goes up 20%, even if they place the exact same policy volume as last year. It's exactly. A prolonged period of rising insurance premiums translates directly into outsized organic revenue and profit growth for Marsh and Guy Carpenter. This leverage to the insurance cycle can create massive boosts in earnings that the market often fails to fully anticipate, driving the stock price higher.
And the second catalyst is more of an internal operational story, the margin expansion potential.
Right. Successful operational integration and technology centralization. Management is actively consolidating certain back-end and client services functions across the four businesses, streamlining processes and centralizing IT spend. When they execute this effectively, the resulting operational synergies and cost savings lead directly to margin expansion, proving that the whole is more efficient than the individual parts.
Okay, we've covered the good. We must now address the most critical element, the permanent risks, the existential threats that could permanently destroy the investment thesis and the moat itself.
There are three primary long-term risks, I think. The first is technological disintermediation, which directly targets the brokerage mechanism.
Meaning, AI or insurtech platforms could bypass the broker entirely, cutting out the middleman and their fees. How real is this threat?
It is a profound but not yet immediate threat. The risk is that advanced AI platforms or decentralized insurtech solutions become sophisticated enough to perform complex underwriting, risk modeling, and even policy structuring directly for large corporations or insurers.
Which would erode the broker's informational advantage.
Completely. If this happens, their high commissions and fees, their entire revenue base, would face severe pricing pressure. It would reduce them from a sophisticated consultant to a mere transactional agent.
That hits the data moat. The second risk targets the intangible asset, reputational damage and loss of trust.
And this is the most devastating. Those 150 years of trust can be ruined in one material, highly publicized error, a massive failure in risk placement, a high-profile compliance scandal in a major market, or, material negligence in advising on a multi-billion-dollar cyber or climate event.
If trust breaks down,
the client immediately defects and the moat vanishes, regardless of how good their data or technology might be.
Because at the end of the day, people are buying the assurance that their advisor has their fiduciary interest at heart.
Precisely. You are buying certainty in chaos. If they fail to deliver that, their primary asset is gone.
And the third risk is the always present threat of aggressive regulatory intervention.
New legislation, especially in major markets like the US or the EU, that aggressively caps brokerage commissions or mandates government-backed risk pools for specific high-risk areas, like major flood or terrorism risk. This would fundamentally alter the industry's favorable economics overnight.
It would turn the high-margin Tollbooth into a public utility.
With government-mandated profitability caps. And it forces the broker to focus purely on volume and cost cutting rather than sophisticated high-margin advice. It changes the entire game.
Let's synthesize all our findings now. What is the market consensus, and where does our deeper analysis find a potential edge or a different point of view?
Well, market consensus, based on most analyst reports, is generally hold or neutral. MMC is viewed as a high-quality, predictable grower, but fairly valued at its current premium multiple. The consensus worries primarily about short-term cyclicality in insurance pricing and a potential slowdown in discretionary consulting spending.
That's the first level thinking. So where do we diverge, incorporating the Lollapalooza effect and those structural tailwinds?
I think we give greater weight to two factors the market often underprices. First, the long-term margin expansion potential from that internal centralization and operational efficiency. And second, the durability and acceleration of demand driven by systemic risk complexity.
So we believe the market often views MMC as simply a cyclical broker.
Whereas the integrated model is actually a secular complexity advisor. It's a different kind of business.
The unpriced factor, then, is the compounding effect of complexity meeting integration.
Yes. Systemic risk complexity is a permanent tailwind that fundamentally increases the intrinsic value of MMC's integrated offering. We would argue that the current premium, while high, is a defensible price for a business with such predictable compounding power.
Okay, so let's solidify the bull case. The core reasons to own this company for the long term.
First, the core business is protected by a wide, durable moat built on 150 years of trust, proprietary data, and global brand recognition. This ensures high client stickiness and real pricing power.
Second, it's a structurally capital-light business leading to exceptionally high free cash flow conversion and consistently high ROIC. That makes it a reliable compounding machine that requires very little external capital.
Third, the secular tailwinds from global risk complexity, cyber, climate, geopolitical fragmentation act as non-cyclical, accelerating drivers of demand for their high-margin advice.
And fourth, disciplined, owner-oriented management that allocates capital rationally, prioritizing internal high ROIC investments, a growing dividend, and those opportunistic share buybacks.
Now for the bear case. The counter-thesis that challenges our most bullish assumptions. What could go wrong?
First, the valuation premium is fragile. Given the high multiple, any minor hiccup in organic growth, especially if in consulting demand slows or insurance pricing softens, could lead to a massive, swift multiple contraction, potentially destroying shareholder returns very rapidly.
Second, operational dependence on human capital. Their primary asset is elite talent. If they fail in the competitive talent wars, or if the high-margin consulting model is permanently disrupted by shifts in client preference or remote work dynamics, their core expense base becomes unsustainable.
Third, short-term earnings are inherently tied to the volatile, cyclical P&C insurance pricing environment. A prolonged soft market where premiums fall dramatically will absolutely pressure brokerage revenue growth, making it much harder to justify the stock's growth trajectory.
And fourth, the persistent risk of value destruction from potential future M&A. Despite their current discipline, a single misguided large acquisition could impair the balance sheet and distract management from the core mission, destroying value very, very quickly.
We've saved the most critical exercise for last, the red team challenge. We have to invert the thesis and detail the most compelling argument for why this investment could become a catastrophic long-term mistake.
And the ultimate catastrophic scenario is the simultaneous failure of the two moats. The complete erosion of trust and data superiority at the exact same time.
A perfect storm.
Exactly. Let's start with scenario one. The complete public erosion of the intangible asset trust. Imagine a massive, multi-billion-dollar litigation event following a devastating global cyber attack. The client publicly alleges that Marsh's advice was materially negligent in placing or structuring the risk, leading to massive uninsured losses.
So this single, highly publicized failure permanently damages the Marsh brand's 150-year reputation for fiduciary trust,
Causing a cascade of high-value client departures. The trust is broken.
Now, how does the data moat fail concurrently with that?
Concurrently, a new massive InsurTech consortium leveraging truly advanced open-source AI and proprietary machine learning models democratizes access to better, faster, and cheaper risk modeling data. This new model eliminates Guy Carpenter's core intellectual advantage, its proprietary data superiority. All the secrets they've accumulated over a century are suddenly available for free or for far less cost to any competitor.
If both of those things happen simultaneously, the reputation damage and the knowledge democratization, What is the inevitable result for the stock?
The premium valuation instantly collapses. MMC is reduced from a high-margin complexity advisor to an expensive, easily replaceable transactional agent. The highly paid human capital, which was once their greatest asset, becomes an expensive cost center with vastly diminished client relevance and little to no pricing power.
And the entire investment thesis, built on superior trust and superior data, just dissolves into commodity pricing.
Leading to permanent impairment of the invested capital.
That is the crucial monitoring point for any investor in MMC. Are they maintaining impeccable compliance and trust standards globally? And are their investments in predictive data analytics still ahead of the market curve?
So, as we close this deep dive on Marsh McLennan, the enduring lesson here is that true long-term wealth generation often flows from these highly integrated capital-light models whose primary asset trust, reinforced by proprietary data, is inherently non-replicable, provided, of course, they maintain discipline.
It's a classic example of quality rarely coming cheap. But quality, when bought judiciously and held with patience, can compound value faster and more safely than almost any other category of business. Understanding those subtle connections, that Lollapalooza effect, is really the key to justifying that premium valuation.
And for you, the learner, we leave you with one final provocative thought to chew on. If trust is the ultimate intangible asset in this business, what specific future technological breakthrough would be required to not just replace the broker, but to fundamentally discredit the global 150-year-old reputation of the Marsh brand? What evidence of that shift are you going to actively watch for in the coming quarters to ensure the moat remains intact?
That's the real question that separates the thinkers from the traders. Thank you for joining us on this deep dive into MMC. We hope this comprehensive analysis helps sharpen your own investment process. We'll see you next time.